In 2024, the stock market went up 25%, but the average investor earned only 16.5%. That's an 8.5% gap. And it's not bad luck, it's behavior. The people who close that gap don't pick stocks, they don't time the market, they do one simple thing consistently. But before I tell you what it is, let me first show you what most beginners get wrong. Most beginners try to predict the market. They try to pick the next big stock. And that's exactly where they go wrong. Here's the thing, nobody can predict the market. Not experts, not professionals. Even Warren Buffett says he doesn't know what the market will do tomorrow. So even if he can't predict it, why do we think we can? The research shows that failed attempts to time the market are the main reason investors underperform. That's why the 8.5% gap exists. Not because people are stupid, because they are trying to do something that's impossible. So, what actually works? What do the people who close that gap do differently? There are three simple concepts. Let's start with the first one. The first concept is called dollar cost averaging. It sounds fancy, but it's actually very simple. Here's how it works. You invest the same amount of money at regular intervals, every month, every week, no matter what the market is doing. Why does this work? Because it removes the risk of trying to time the market. By spreading your purchases over time, you avoid the danger of investing all your money at a market peak right before a crash. And here's the smart part. When prices are low, your fixed contribution buys more shares. When the market recovers, those extra shares boost your portfolio. It removes emotion from investing. You don't panic when the market drops, you just keep buying. Let me show you a real example. Imagine you invest $100 every month for 12 months. If you invested all $1,200 at $10 per share, you'd own 120 shares. But if you invest $100 every month, your average price comes down to around $9.46 and you'd own 126 shares. That's more shares for the same amount of money. That's dollar cost averaging. You don't have to guess the right time. You just buy consistently. Now you might be thinking, that makes sense, but what do I actually buy? That brings me to the second concept. The second concept is index funds and ETFs. An index fund holds a collection of stocks that mirror a benchmark, like the S&P 500. In simpler terms, instead of picking one company, you own a small piece of the whole market. When you buy an S&P 500 index fund, your money is spread across all 500 companies. Why is this smart? First, it gives you diversification. If one company fails, your entire portfolio doesn't collapse. Second, index funds have low fees. Actively managed funds charge 1% or more. Index funds charge as little as 0.03%. That difference adds up over decades. Third, index funds outperform most active investors over time. Warren Buffett made a famous bet. He bet that an index fund would beat a group of professional hedge fund managers over 10 years. He won. The index fund performed better. Buffett has said a low cost index fund is the most sensible investment for most people. So, if you don't know where to start, an index fund is a great place to begin. Now, let me show you why starting early matters so much. The third concept is compounding. This is where things get powerful. Compounding is when you earn returns on your original investment and also on the returns you already earned. It's interest on interest. A student described it perfectly. Not only you will earn money on the principal amount, but you will also earn interest on the interest you've already earned. Here's an example. Invest $1,000 at 8% return. After year 1, you have $1,080. After year 2, you have $1,166. Over 35 years, that growth becomes massive. Einstein is believed to have called compounding the eighth wonder of the world. Here's another example. If you invest $100 every month for 30 years at 8% return, you don't just get $36,000. You get around $150,000. That's compounding at work. The earlier you start, the more time your money has to grow. In the beginning, growth feels slow, but over time, it speeds up. That's why starting early matters so much. So now you know the three concepts, but what do you actually do with them? Here's the simple plan. Step 1: open a brokerage account. You can do this through apps like Fidelity, Vanguard, or similar platforms in your country. Step 2: buy an index fund that tracks a broad market index like the S&P 500. And step 3: set up automatic monthly investments. Even if it's just $50 or $100 a month, automate it so you don't have to think about it. That's it. Don't check it every day. Don't panic when the market drops. Just keep investing consistently. The best time to start was yesterday. The second best time is today. Invest consistently, buy index funds, let compounding do the work. That's it. That's the strategy that beats the experts. This is VaultMind. We expose illusions and teach real thinking about money and psychology. Subscribe if you want more and comment below what's stopping you from investing. I read the best answers in the next video. Thanks for watching. I'll see you in the next one.